C. Zero coupon bonds and ski masks. Berkshire issued $902 million principal amount of zero coupon convertible subordinated debentures, which are now listed on the New York Stock Exchange. Salomon Brothers handled the underwriting in superb fashion, providing us helpful advice and flawless execution. Most bonds, of course, require regular payments of interest, usually semi-annually. A zero-coupon bond, conversely, requires no current interest payments. Instead, the investor receives his yield by purchasing the security at a significant discount from maturity value. The effective interest rate is determined by the original issue price, the maturity date, and the amount of time between issuance and maturity. In our case, the bonds were issued at 44.314% of maturity value and are due in 15 years. For investors purchasing the bond, that is the mathematical equivalent of a 5.5% current payment compounded semi-annually. Because we received only $44.31 on the dollar, our proceeds from this offering were $400 million, less about $9.5 million of offering expenses. The bonds were issued in denominations of $10,000, and each bond is convertible into 0.4515 shares of Berkshire Hathaway. Because a $10,000 bond cost $4,431, this means that the conversion price was $9,815 per Berkshire share, a 15% premium to the market price then existing. Berkshire can call the bonds at any time after September 28, 1992, at their accredited value, the original issue price plus 5.5% compounded semi-annually, and on two specified days, September 28th of 1994 and 1991, the bondholders can require Berkshire to buy the securities at their accreted value. For tax purposes, Berkshire is entitled to deduct the 5.5% interest accrual each year, even though we make no payments to the bondholder. Thus, the net effect to us, resulting from the reduced taxes, is positive cash flow. That is a very significant benefit. Some unknowable variables prevent us from calculating our exact effective rate of interest, but under all circumstances, it will be well below 5.5%. There is meanwhile a symmetry to the tax law. Any taxable holder of the bonds must pay tax each year on the 5.5% interest, even though he receives no cash. Neither our bonds, nor those of certain other companies that issued similar bonds last year, notably Lowe's and Motorola, resemble the great bulk of zero-coupon bonds that have been issued in recent years. Of these, Charlie and I have been, and will continue to be, outspoken critics. As I will later explain, such bonds have often been used in the most deceptive of ways and with deadly consequences to investors. But before we tackle that subject, let's travel back to Eden, to a time when the apple had not yet been bitten. If you're my age, you bought your first zero-coupon bonds during World War II by purchasing the famous Series E U.S. savings bond, the most widely sold bond issue in history. After the war, these bonds were held by 1 out of 2 U.S. households. Nobody, of course, called the Series E a zero-coupon bond, a term in fact that I doubt had been invented, but that's precisely what the Series E was. These bonds came in denominations as small as $18.75. That amount purchased a $25 obligation of the United States government due in 10 years, terms that gave the buyer a compounded annual return of 2.9%. At the time, this was an attractive offer. The 2.9% rate was higher than that generally available on government bonds, and the holder faced no market fluctuation risk, since he could at any time cash in his bonds with only a minor reduction in interest. A second form of zero-coupon U.S. Treasury issue, also benign and useful, surfaced in the last decade. One problem with a normal bond is that even though it pays a given interest rate, say 10%, the holder cannot be assured that a compounded 10% return will be realized. For that rate to materialize, each semi-annual coupon must be reinvested at 10% as it is received. If current interest rates are, say, only 6% or 7% when these coupons come due, the holder will be unable to compound his money over the life of the bond at the advertised rate. For pension funds and other investors with long-term liabilities, reinvestment risk of this type can be a serious problem. Savings bonds might have solved it, except that they are issued only to individuals and are unavailable in large denominations. What big buyers needed was huge quantities of savings bond equivalents. Enter some ingenious and, in this case, highly useful investment bankers, led, I'm happy to say, by Solomon Brothers. They created the instrument desired by stripping the semi-annual coupons from standard government issues. Each coupon, once detached, takes on the essential character of a savings bond, since it represents a single sum due sometime in the future. For example, if you strip the 40 semi-annual coupons from a US government bond due in the year 2010, you will have 40 zero-coupon bonds with maturities from 6 months to 20 years, each of which can then be bundled with other coupons of like maturity and marketed. If current interest rates are, say, 10% for all maturities, the 6-month issue will sell for 95.24% of maturity value, and the 20-year issue will sell for 14.2%. The purchaser of any given maturity is thus guaranteed a compounded rate of 10% for his entire holding period. Stripping of government bonds has occurred on a large scale in recent years as long-term investors ranging from pension funds to individual IRA accounts recognize these high-grade, zero-coupon issues to be well-suited to their needs. But as happens in Wall Street all too often, what the wise do in the beginning, fools do in the end. In the last few years, zero-coupon bonds and their functional equivalent, pay-in-kind bonds, which distribute additional PIK bonds semi-annually as interest instead of paying cash, have been issued in enormous quantities by even junkier credits. To these issues, zero or PIK bonds offer one overwhelming advantage: it is impossible to default on a promise to pay nothing. Indeed, if LDC governments had issued no debt in the 1970s other than long-term zero-coupon obligations, they would now have a spotless record as debtors. This principle at work, that you need not default for a long time if you solemnly promise to pay nothing for a long time, has not been lost on promoters and investment bankers seeking to finance even shakier deals, but its acceptance by lenders took back a while. When the leveraged buyout craze began some years back, purchasers could borrow only on a reasonably sound basis in which conservatively estimated free cash flow, that is, operating earnings plus depreciation and amortization, less normalized capital expenditures, was adequate to cover both interest and modest reductions in debt. Later, as the adrenaline of dealmakers surged, businesses began to be purchased at prices so high that all free cash flow necessarily had to be allocated to the payment of interest. That left nothing for the paydown of debt. In effect, a Scarlett O'Hara "I'll think about it tomorrow" position in respect to principal payments was taken by borrowers and accepted by a new breed of lender, the buyer of the original issue junk bonds. Debt now became something to be refinanced rather than repaid. The change brings to mind a New Yorker cartoon in which the grateful borrower rises to shake the hand of the bank's lending officer and gushes, "I don't know how I'll ever repay you." Soon, borrowers found even the new, lax standards intolerably binding. To induce lenders to finance even sillier transactions, they introduced an abomination, EBDIT, earnings before depreciation, interest, and taxes, as the test of a company's ability to pay interest. Using this sawed-off yardstick, the borrower ignored depreciation as an expense on the theory that it did not require a current cash outlay. Such an attitude is clearly delusional. At 95% of American businesses, capital expenditures that over time roughly approximate depreciation are a necessity and are every bit as real an expense as labor or utility costs. Even a high school dropout knows that to finance a car, he must have income that covers not only interest and operating expenses, but also realistically calculated depreciation. He would be laughed out of the bank if he started talking about EBIT. Capital outlays at a business can be skipped, of course, in any given month, just as a human can skip a day or even a week of eating. But if the skipping becomes routine and is not made up, the body weakens and eventually dies. Furthermore, a start and stop feeding policy will over time produce a less healthy organism, human or corporate, than that produced by a steady diet. As businessmen, Charlie and I relish having competitors who are unable to fund capital expenditures. You might think that waving away a major expense such as depreciation in an attempt to make a terrible deal look like a great one hits the limits of Wall Street's ingenuity. If so, you haven't been paying attention during the past few years. Promoters needed to find a way to justify even pricier acquisitions, otherwise they risked, heaven forbid, losing deals to other promoters with more imagination. So, stepping through the looking glass, promoters and their investment bankers proclaimed that EBIT should now be measured against cash interest only, which meant that interest accruing on zero coupon or PIK bonds could be ignored when the financial feasibility of a transaction was being assessed. This approach not only relegated depreciation expense to the let's ignore corner, but gave similar treatment to what was usually a significant portion of interest expense. To their shame, most professional investment managers went along with this nonsense, though they usually were careful to do so only with clients' money, not their own. Calling these managers professionals is actually too kind. They should be designated promotees. Under this new standard, a business earning, say, $100 million pre-tax and having debt on which $900 million of interest must be paid currently, might use a zero coupon of PIK issue to incur another $60 million of annual interest that would accrue and compound but not come due for some years. The rate on these issues would typically be very high, which means that the situation in year 2 might be $90 million cash interest plus $69 million accrued interest, and so on as the compounding proceeds. Such high-rate reborrowing schemes, which a few years ago were appropriately confined to the waterfront, soon became models of finance at virtually all major investment banking houses. When they make these offerings, investment bankers display their humorous side. They dispense income and balance sheet projections extending 5 or more years into the future for companies they barely had heard of a few months earlier. If you are shown such schedules, I suggest that you join in the fun. Ask the investment banker for the one-year budgets that his own firm prepared as the last few years began, and then compare these with what actually happened. Some years ago, Ken Galbraith, in his witty and insightful The Great Crash, coined a new economic term, the bezel, defined as the current amount of undiscovered embezzlement. This financial creature has a magical ability. The embezzlers are richer by the amount of the bezel, while the embezzlees do not yet feel poorer. Professor Galbraith astutely pointed out that this sum should be added to the national wealth, so that we may know the psychic national wealth. Logically, a society that wanted to feel enormously prosperous would both encourage its citizens to embezzle and try not to detect the crime. By this means, wealth would balloon, though not an erg of productive work had been done. The satirical nonsense of the bezel is dwarfed by the real-world nonsense of the zero-coupon bond. With zeros, one party to a contract can experience income without his opposition experiencing the pain of expenditure. In our illustration, a company capable of earning only $100 million annually, and therefore capable of paying only that much in interest, magically creates earnings for bondholders of $150 million. As long as major investors willing don their Peter Pan wings and repeatedly say, I believe, there's no limit to how much income can be created by the zero-coupon bond. Wall Street welcomed this invention with the enthusiasm less enlightened folk might reserve for the wheel or the plow. Here, finally, was an instrument that would let the street make deals at prices no longer limited by actual earning power. The result, obviously, would be more transactions. Silly prices will always attract sellers, and, as Jesse Unruh might have put it, transactions are the mother's milk of finance. The zero-coupon bond or PIK bond possesses an additional attraction for the promoter and investment banker, which is that the time elapsing between folly and failure can be stretched out. This is no small benefit. If the period before all costs must be faced is long, promoters can create a string of foolish deals and take in lots of fees before any chickens come home to roost from their earlier ventures. But in the end, alchemy, whether it is metallurgical or financial, fails. A base business cannot be transformed into a golden business by tricks of accounting or capital structure. The man claiming to be a financial alchemist may become rich, but gullible investors rather than business achievements will usually be the source of his wealth. Whatever their weakness, we should add, many zero-coupon and PIK bonds will not default. We have in fact owned some, and may buy more if their market becomes sufficiently distressed. We've not, however, even considered buying a new issue from a weak credit. No financial investment is evil per se, it's just that some variations have far more potential for mischief than others. The blue ribbon for mischief making should go to the zero coupon issuer, unable to make his interest payments on a current basis. Our advice: whenever an investment banker starts talking about EBIT, or whenever someone creates a capital structure that does not allow interest, both payable and accrued, to be comfortably met out of current cash flow net of ample capital expenditure, zip up your wallet. Turn the tables by suggesting that the promoter and his high-priced entourage accept zero coupon fees, deferring their take until the zero coupon bonds have been paid in full. See then how much enthusiasm for the deal endures. Our comments about investment bankers may seem harsh, but Charlie and I, in our hopelessly old-fashioned way, believe that they should perform a gatekeeping role, guarding investors against the promoter's propensity to indulge in excess. Promoters, after all, have throughout time exercised the same judgment and restraint in accepting money that alcoholics have exercised in accepting liquor. At a minimum, therefore, the banker's conduct should rise to that of a responsible bartender who, when necessary, reduces the profit from the next drink to avoid sending a drunk out on the highway. In recent years, unfortunately, many leading investment firms have found bartender morality to be an intolerably restrictive standard. Lately, those who have traveled the high road in Wall Street have not encountered heavy traffic. One distressing footnote: the cost of the zero coupon folly will not be borne solely by the direct participants. Certain savings and loan associations were heavy buyers of such bonds, using cash that came from FSLIC insured deposits. Straining to show splendid earnings, these buyers recorded, but did not receive, ultra-high interest incomes on these issues. Many of these associations are now in major trouble. Had their loans to shaky credits worked, the owners of the associations would have pocketed the profits. In the many cases in which the loans will fail, the taxpayer will pick up the bill. To paraphrase Jackie Mason at the associations, it was the managers who should have been wearing the ski masks.